Welcome back to the 90s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 99 Capital Group. Thank you guys for joining. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at MLB2CFP or at 9iCap. Today we're talking about the Fed 25 basis points, what it means to you, and give you some ins and outs on how this system works. Guys, this is just some inside baseball. Let's get it. So Jerome Powell came out and said 25 bips, that's what we're getting. We're cutting rates. But let's talk about the Fed and what its mandate actually is. The Fed has two mandates: price stability, full employment. Right now, unemployment is ticking higher. Growth is slowing. The Fed is looking for ways to juice the economy. Their tool of choice, lowering short-term rates. Now, the idea is simple. You're lowering short-term rates to make borrowing costs lower, so businesses can expand, consumers can spend, growth picks up. A 25 basis point cut is supposed to signal confidence while offering a small nudge to activity. But here's the problem. Does 25 basis points truly even matter? For the average consumer, no. Borrowing costs are still high. You're probably seeing rates on your credit cards, depending on your credit worthiness, $19.99, $29.99, some people over 30%. So no, it's not necessarily giving you that boost that you needed. Banks and lending institutions have tightened their standards. Even if rates come down, credit may be harder to get. Larger loans like mortgages, business financing, they don't suddenly get cheaper overnight. So while the narrative is about helping Main Street, in practice, this cut doesn't change much for you or me or the end consumer. It doesn't help us. It doesn't help us right now. So the question I often hear is, well, who really benefits? Let's call it what it is. Let's call this what it actually is. This is about government borrowing. Case in point, the U.S. government is sitting on a massive debt load. Lowering short-term rates gives the Treasury breathing room to refinance and roll over its obligations to lower cost. Think of it like refinancing your mortgage, but on a multi-trillion-dollar scale. By trimming short-term rates, the Fed tries to offset the burden of longer-term rates. It's less about sparking consumer demand, more about managing the government's own balance sheet. Why do I say that? Because the current administration has policy. That policy that was in the OBBBA is based on a future expected interest rate at what they are expected to borrow. Now, if that rate is drastically higher than they're expecting, they're going to have to take into account that, oh my God, instead of us paying $12 trillion over a 10-year period, that may be $13 trillion or $14 trillion or $15 trillion in interest. So it's imperative that they get these rates down so their average rate that they're using to calculate future debt costs is in line with their estimates. So when they're spending money, it's more in line versus out of line, which again, the expected debt is expected to be up, $3 to $5 trillion over the next 4 years. So with that being said, that's the main reason why they're having these conversations about lowering short-term rates. And just to be completely fair, this current administration is not the first administration that attacked the Fed. Most presidents always attack the Fed because, well, they want to spend to boost their economy. That is the name of the game. So what about mortgage rates? They said that, well, if we get these rates down, mortgage rates should come down. Well, they tried this before. They've tried to reduce short-term rates. And what happened to the long end of the curve? The long end of the curve went up 100 basis points. Recently, the short-term, the 10-year was coming down right or at near 4. Right now, I mean, I don't want to, it's about 4.15. So ever since they went in and said, we're dropping it by 25 basis points, the 10-year treasury went up. And why is the 10-year treasury important? Because that is what is used to base your borrowing costs as a consumer. So, like I said, the question I hear is, what about mortgage rates? It's not going to impact mortgage rates very significantly. Mortgage rates aren't controlled directly by the Fed. They're driven by market participants, investors who buy and sell mortgage-backed securities. For mortgage rates to really come down, the Fed would need to do a couple of things. They can buy mortgages in the open market, artificially tapping down yields, or they can cut aggressively, which could backfire because long-term rates could spike as investors worry about inflation. So if you're waiting for a 25 basis point from the Fed cut to magically lower your mortgage, don't hold your breath because it's likely not going to happen. We got these people called bond vigilantes that are there to keep spending in check. And by the way, there's a huge disconnect because we still have inflation. So the disconnect, when I talked about inflation, is it makes you start to think. The first thing is we're constantly told one thing versus what's really going on. So here's the bigger picture. The administration says the economy is strong. Well, perfect. If the economy is strong, we don't need any rate cuts, right? Wrong. They point to GDP growth, stock market levels, job creation. But if everything is so great, why are we cutting rates? That's the contradiction. If the economy were humming along, there would be no need for stimulus. Look at the real data on the ground. Grocery prices are still climbing. Energy costs remain elevated. Insurance premiums, home, auto, health, all squeezing households. Debt is more expensive across the board, and the job market, it's on pause. Companies aren't hiring like they were, and more people are falling out of the workforce. So when the Fed cuts rates, it's less a sign of strength and more an admission that things are actually weakening. Our job market is in dire straits. So they're trying to get people back into the job market by giving better borrowing costs to companies. But if companies can't refinance their debt or have access to capital at much lower rates, it's very hard to stimulate that environment, especially, and I'm going to say that, especially when prices are moving for higher every single day. Grocery stores, energy prices, it's hitting the end consumer. So the Fed has a problem at this current time. So I want to close with this. We are in a situation where the Fed has a balancing act. We always hear about, is the Fed going to land this plane? Is it going to be a soft landing? We've been hearing about a soft landing over the past decade, and we're still in the air. Why? Because the Fed continues to give the market stimulus, and now we are in danger of overheating. We are in danger of overheating because they cannot get prices down. If prices don't come down, they cannot lower rates that much more quickly because prices will start to move higher, and the end consumer is going to do one of two things. It's going to demand higher wages, or it's going to boycott the system altogether, which is going to destroy GDP. These are the things that we have to worry about. So to wrap this up, the Fed cuts rates because unemployment is rising and growth is slowing. A 25 basis point cut is symbolic more than practical. It won't move the needle for many borrowers. The real beneficiary is the federal government refinancing trillions in debt. Mortgages won't meaningfully change unless the Fed intervenes directly in the mortgage market, and the strong economy narrative doesn't line up with what households are actually experiencing. The takeaway: don't get caught up in the headlines. Look at the reality on the ground. Rate cuts aren't the silver bullet for consumers. They're a lifeline for the system itself. I hope you understand what I'm actually saying. These rate cuts that are coming are more for companies, are more for government and institutions. For the end consumer, it's not going to impact you much. Yeah, you may get a little bit cheaper rate on a financing deal for a vehicle or whatnot, but it's not going to be that material because you have other things coming on the back of that that's going to offset any of that you're receiving. We still haven't seen the tariff impact the numbers yet. So the current inflation that we're seeing, which is far worse than we could imagine, is that if this is not tariff related, which it's not, because the tariff's going to come on top of that, this is what we call sticky inflation. Sticky inflation, which is inflation that ain't never going away. Sticky inflation that means that wages are going to have to increase. Sticky inflation, which means that, hey, the tariffs, when they come on top of that, it's going to be a boom, one-time price hike, which again, boom, prices go up even more. It's a self-fulfilling inflationary environment we are in currently, and we have to manage it effectively. I hope this has been a valuable use of your time. Thanks you guys for tuning into the 9 Innings Podcast. If you found this helpful, share it with a friend, subscribe, and stay tuned. We've got more things coming your way, more ways to dive deep into these types of things. Please, like I always say, subscribe to the channel. Go and get my book, Get My Beat to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Thank you guys for listening. Stay humble, stay safe, my friends. I'll see you again soon.